Do you know what today is? Evelyn is the big 40. She's 40. Evelyn has just turned 40 today. Happy birthday, Evelyn. Evelyn, it's your birthday. We used to watch The Simpsons back in the day. One time they had like a guest, Michael Jackson, on, and at the end they're like, "Oh, Michael Jackson just came up with this custom happy birthday song for Lisa, the actor, whatever, on The Simpsons, Lisa, the daughter." And then we're expecting this huge, like, oh, this amazing song from Michael Jackson, and that's all it was. Happy birthday, Lisa. Lisa, it's your birthday. And then repeat. We're like, what the hell's that? Come on, Michael. All the songs you did, son. So, anyways, Evelyn's birthday is today. Evelyn's birthday. Peakprosperity.com. I was just talking the other day about these negative interest rates and how it could cause your monthly payment to go way down. But I thought, well, maybe the price of the house will come down with it. But then I thought the other side, well, maybe the prices would go up even higher. Because if the mortgage goes down as you pay it, again, you have a $250,000 mortgage in that example I gave. In 30 years, you pay $167,000 with negative interest rates, the example I gave. So why would you want to pay it off early, right? It's like, doesn't make sense. But your payments are way low. Therefore, you could technically afford more of a house. So I thought, well, yeah, I guess prices could go down. But then again, no, wait a minute. Maybe the prices would go up because your mortgage rates are still going to be way down. Wasn't real sure, but peakprosperityhere.com says why housing is about to go on sale. And he starts off with saying, first of all, the growing threat to paper assets. With negative interest rates metastasizing across the globe and central banks once again speaking in unison about resuming QE, also known as massive money printing, we have a pretty good sense that we're approaching the limits of currency monetary policy after a decade of injecting tens of trillions of dollars of thin air money into the world economy. What do the central planners actually have to show for it? Not a return to robust economic growth, which was the outcome that was sold to us. We'd have this robust economic growth, and that's not exactly what happened. Especially when you're looking at the world, all the European Central Bank for the European Union. Not a normalization of the short-term emergency measures, which was also promised, right? We'll go back to normal. This is just a short-term thing. No, it's been going on forever, ever since 2008. Now, of course, our country in America here, we're going to do a reverse QE. We're going to unwind. And I said then, this isn't going to last long. If they can even do this, it's not even going to last long. And sure enough, here we are again today, and Donald Trump is saying to the Fed, you need to start QE, and you need to drop the interest rates. Matter of fact, it might not even hurt if we went negative. Isn't that amazing? And I'm just a guy, no college education, just studying things that I get my hands on, not paying attention to the news, the mainstream articles. I find the real information, and then I share it with you guys. Instead, we have had rampant inflation in the prices of all assets that the elites own. For everyone else, the cost of living has exploded, but wages have been stagnant. Savers have been starved of return. Companies have borrowed to reward their executives handsomely, while investing in automation, eliminating an even greater percentage of jobs. We're left with the widest wealth gap in U.S. history, one that's worsening every year. The response from the central banks at this point is clear: to do more of what is not working, to intervene more, to double down, and then triple down. The latest example, Mario Draghi's the Eurozone swan song stimulus announcement from yesterday. He puts a link to it. So as we look into the future, we see a high risk of the world money supply increasing further, or put in layman's terms, your money being devalued by rampant inflation, which is why we've long been advocates of owning inflation-adjusted income streams produced by tangible assets, productive farmland, profitable businesses, resource mining companies, investment real estate property. These are investments whose innate value can't be inflated away. As more money is printed, their product prices will keep pace with inflation. Plus, you'll be building long-term equity along the way. But our odds are high that we won't simply ride up the inflation curve in a straight line from here. Deflationary corrections, perhaps severe ones, will punctuate the process. And when they do, windows of very attractive investment opportunities will open. Take real estate, which appears to be entering the start of a correction now. And you'll recall when I first started talking cryptos, well, not first, but heavy duty talking, 2017, I said, man, if we could just time this right, and it's not about you and I timing it, it's really the way the market works, but I said, if we could just time this right, if this just pans out for us, cryptos, we're buying them now, they start exploding in price, housing and other assets start crashing, next thing you know, we're buying these cheap houses with this crypto that we've turned into huge profits, we don't have to get a loan, mortgage, we just buy these houses or properties. Remember that? And I said, that would be great. I said, you're going to see things like on Craigslist when stuff starts really dumping, people selling, little toys, four-wheelers and jet skis, and all that, they're going to be panic selling everything. And if you have the money, you'd be the one that buys it, if you wanted it. Anyways, why housing is about to go on sale. At some point, housing prices become so expensive that no matter how low interest rates go, the average household simply can't afford to buy. So, you catch that? At some point, housing prices become so expensive that no matter how low interest rates go, the average household simply cannot afford to buy. We may very well be at that point now, but even if not yet, it's clear that the tremendous tailwind driving U.S. housing prices since the great financial crisis in 2008 is sputtering out. With this year's plummet in mortgage rates and the seasonally strong summer months just ended, one would expect a strong boost to home sales. But instead, Realtor.com just reported a highly unusual price drop from July to August, the largest summer decline seen since the company started compiling this data. Suddenly, and it looks like it goes back to 2001, from what I can tell. Or no, let's see, January 2003, up until almost last quarter of 2018, or was that first of 2019? I don't know. Can't really tell. Suddenly, many of the most incandescent of the red-hot U.S. housing markets are now cooling off and cooling off fast. This list of the 16 fastest shrinking housing markets, which includes San Francisco, shocker, San Jose, and Boulder, Colorado. It's not just prices that are slumping. Home construction is plummeting in hot markets too. Take San Diego, which just reported that there were 43% fewer homes built in H1, or is that quarter one? What the hell is H1? 2019 than a year prior. All of Southern California fell 25% for the same period. Again, I'm talking parts of California when, $700,000 house, how many square foot? Like 700 square foot. You live in a tiny shack for $700,000. Yeah, I'm talking that. And that stuff fell 25%? Interesting. What's behind the sudden softening? Well, as mentioned, affordability is a big issue. While wage growth has been anemic since the Great Recession, U.S. household debt is now higher than it has ever been. So I'm looking at this little chart, total debt balance and its composition. And I can see where in 2008 it peaked. Not surprising, right? That was the peak, and then we had the crash of everything. And then it came back down by 2013. It dropped down quite a bit from the peak in 2008. However, we've been chugging along ever since then, 2013. And we are now at the all-time high. And it's pretty much everything. So there's mortgages, HE revolving, I guess that's home equity, auto loans, credit card debt, it's all listed, student loan debt, which has gotten huge, by the way, and then other, of course, is the tiniest. And shockingly, credit card debt's not as quite as bad as I was thinking it might look on this graph, anyways. But it's still there, and it's still peaking like with the rest of them. So, anyways, home prices meanwhile are back over their 2007 bubble highs, leading Robert Shiller, the famed co-developer of the Case-Shiller Home Price Index charted below, to state last week, quote, "I wouldn't be surprised at all if house prices started falling," end quote. And once again, I'm looking at the chart, the S&P CoreLogic Case-Shiller indices, whatever. In 2000, again, between 2005 and 7, we peaked for housing. Then it crashed 2009, 10, 11, 12. And then again, 13. And then we started this rampant climb up. We are back to the highs again. We're actually higher than we were, according to what I'm looking at. Beyond affordability, fear is becoming a factor. Isn't that what Joe Rogan used to say? Fear is not a factor for you. Beyond affordability, fear is becoming a factor after years of absence in the housing market. As we've been covering here at peakprosperity.com, the recent inversion of the yield curve and other too big to ignore recessionary warning signs that have finally caught the attention of the average Joe. A recent ABC News poll shows that now 60% of Americans believe a recession is ahead. With that concern, folks are becoming less enthused to pay the high prices today that today's sellers are asking for. But perhaps no other variable is as important right now as marginal capital flows. We've written in the past about the critical role of the marginal buyer plays in real estate. If she or he disappears, how much less is the next marginal buyer able to afford? Well, we're now finding out. For the past decade, foreign capital has flooded into U.S. real estate, largely to seek a safe haven, though also to chase yield as more and more countries have resorted to negative interest rates. But that flood of money is beginning to dry up, and fast. For the period April 2018 to March 2019, the value of U.S. homes purchased by foreigners dropped 36%, from $121 billion down to just $78 billion. That's the result of capital controls, trade war concerns, a slowing global economy, and a host of other factors. The net result is that a lot less money is flowing in to prop up today's inflated housing prices. And as the data above shows, we're beginning to see the start of a decline. How far will it go? Are we staring at another vicious bursting like we saw from 2007 to 2009? It's too early to tell at this point, but with interest rates near all-time lows, bubble asset price levels in the financial markets, and a recession looming, the outlook is not positive. Now, granted, I understand Trump is in charge. So, is a recession really looming? Is it not? You know what I mean? We got an unknown factor in here now. Whereas before, if anyone else was in there, part 2 would be coming. Now, my guy I called the Cobra had told me back in 2018, towards the latter part of the year, maybe the third quarter, that his guy, who's advised him on things multiple times, had told him back when the first crash was coming in housing to get the hell out, sell his house right away, and rent for a couple years, and then you'll be able to buy a really nice house for cheap. So he listened, and that's exactly what he did. And he goes, Joe, my guy, his guy, is telling me that maybe in about 2 years, roughly, part 2 is coming. Housing crash 2.0 is coming. So I thought that's interesting because that would be, basically 2020, end of 2020, according to when he told me. So it'd be the latter part of 2020. That's next year. So we're into it a year from when he told me last time. Right now, basically 1 more year. Now again, he did say roughly. He didn't say exactly 2 years from now. But again, if we start this whole interest rate thing, dropping all the money that came here as a safe haven, the Chinese money, all the real estate they were buying, like they did in Canada, causing local prices everywhere to go crazy, that's drying up. Oh, we're not going to get yield in America no more? We're getting negative? Oh, I'm pulling out. Sell the assets, sell everything. Those people alone could cause a housing crash. All those foreign buyers. So, I don't know. Again, I can kind of feel like, you can almost see prices, why they could go higher. Again, if you drop interest rates, now people can afford more house than they could before. Typically that would mean, oh, I could raise the price of my house, you know. But the way this guy's saying it is like, well, no, I think with negative rates coming, you're actually going to see a crash in the housing because of everyone pulling out, the foreigners pulling out. And now that does make sense to me. So there's a little bit more here. Well, let's see what else we got. Fortune favors the prepared mind. As we often emphasize, your prospects tomorrow will be determined by the actions you take today. If your take on the data is the same as ours, then it behooves you to ask yourself how you want to be positioned should home prices indeed drop substantially over the next several years. If you own property, perhaps you might want to sell now. Or if you plan to hold, at least mentally prepare yourself for the emotional stress should market values drop for a prolonged period of time. Or if you have tenants, you may want to lock in longer leases to ensure you have the necessary income to ride out the down cycle, or refinance or recapitalize as may make sense. Now on that one, remember what I said, if we go negative interest rates, you could bet your sweet bottom Jason at 4 is going to refinance this house. Whether I'm going to pay it off soon or not, no, that doesn't matter. If we go negative, you are talking substantial savings on a month-to-month mortgage payment. And if you're interested in using a market correction as an opportunity to buy property at much better valuations than today, then you should use the time now to become prepared. Because real estate investing takes serious time to be successful at. You need to understand how real estate as an asset class works and its overall economics. You need to determine which type of property and what market you want to invest in. You then need to get familiar with that niche and start tracking prices and listings to develop an eye for what constitutes good value. You need to identify and recruit a good team of expert professionals to help you, such as a good realtor, good mortgage lender, an accountant, an attorney, property manager, syndicator, etc. And you want to line up your financing. All the above takes time, measured in months at a minimum, to do well. So get started now. There's a little bit more, but I can go ahead and stop now. Yeah, so for me, I mean, I'm not trying to, let me sell the house and get out of here. I don't feel like that. I like this house, I like the property, but I'm prepared to certainly refinance. I'm definitely prepared to refinance. And again, God forbid, cryptos start going way up again, big time. And all this fire sale property comes for sale all over the country. I told you I want to buy up some of these RV places where you bring your RV, you plug in, pay them $20, $30, $4 a day or whatever it is. And you don't have to worry about cleanup. Oh, my air conditioner quit. Oh, I got a leak in the roof. No, that's your problem. It's your RV. You're just plugging into my outlet in the dump station or whatever, like for the toilet. That's all I'm providing. Like, that's great. And they're usually by these campsites or like by sightseeing places. So for me, that was one of the things I thought I'd really like to do that. Even if it meant building a new one somewhere, buying the property and just setting up one somewhere. Put the concrete slabs in, the roadway, the dump stations, all that stuff. And have just a really good, beautiful place to do it. But it takes money, it takes all that stuff. So if cryptos can do what we hope they do, there's the money. That problem is solved. If not, well, maybe I'll just have to refinance until cryptos finally get to where they need to get to. Whatever. I was in cryptos for the long run anyways. I said in the beginning, I think a few years we'll be good to go. A few years isn't, 2017 to 2018 and then now 2019. And we just got started in 2017, for God's sakes. So, anyways, I'm here for the longer run. Another year, 2, 3 years, fine. I don't care. Totally fine with it. But it'll happen when it's supposed to happen. Take care.